You charge $451 per year. Where did that number come from? Why the one?
Have you ever read the book 451 Fahrenheit?
Didn't read it, but I saw the movie.
Yeah, it's the temperature that paper burns. So we're a digital business. We think we can do it cheaper. That's why 451. And the most amazing thing is when we actually came up with that, it's also divisible by 110. So it's perfect for GST, 410 plus GST. It was just meant to be.
Yeah, I've got a question for the king of graphs.
It'd be you, mate.
Today's kind of growing climate change disaster time code, has the moment come where maybe when you do your ABC presenting, you present a graph that tracks the relationship between emissions and growth? And I've got a supplementary, if I may. What's the cult thing with the high dollar for a small economy such as ours that's actually a price taker? Why do we get so excited about a high dollar?
Well, okay, first question, well, it's really a request to start using climate change graphs on the news, is that right?
That actually tracks the relationship, the positive relationship between conventional kind of fossil fuel-based growth with growing emissions. Why don't we see that as an image? Why don't we start to look at the world in that way so that we actually know and see the extent to which conventional growth adds to emissions?
Oh, I see. Okay, I'll have a look at that. I've actually got a graph on this subject on the news tonight.
Far out.
Not exactly like that, but it's from yesterday's speech by Guy Debelle, the Deputy Governor of the Reserve Bank, which I urge everyone to read if you haven't done so already.
Well, there was reports of that this morning again.
Yeah, it's on the RBA website. It's a fantastic speech. Anyway, he's got the cost of solar energy, wind energy, and conventional energy. It's a really interesting graph showing the collapse in the price of solar. But the second thing was
the cult of the high dollar.
Cult of the high dollar
for a price-taking economy like ours, where we don't add value to anything.
I'm not sure there is. I'm not sure there is a high dollar cult. I mean, I think that a lot of people want the dollar to be low. Certainly the Reserve Bank does.
Certainly, that's what I would have thought. But when I watch people reporting where the dollar is, there's tremendous relief. And then the dollar went up. Marvellous.
Well, that's just, yeah. Well, that's if you're a consumer, it improves your buying power for imports. I mean, that's...
So does the ABC pitch itself as at overseas travellers?
Overseas what?
Travellers. Overseas travellers.
Well... Look, I'm not. I can only speak for myself. I'm certainly not jubilant when the dollar goes up. You think I am? I'm not.
I don't think that you would be.
It goes up, it goes down. I mean, market goes up. As Homer Simpson said, this market goes up, market goes down, market goes up, market goes down. I mean, the dollar's float. A lot of floats. It's freely traded. We don't, it goes down. It's been going down for a while now, and it's absorbing the shock in the economy. It's going to go into 60s quite soon.
Quite.
And everyone's going to be quite relieved, I think.
Well, those who understand it, I guess. It's just an anomaly, I think, that I have observed. Thank you for your answers.
No worries.
I got two questions for you. One is that if I have a certain amount of money, for example, $100,000 or whatever, should I give it to you to invest? Or should I buy your listed investment fund, ININ, something? Sorry. Or should I do it myself? Question one. Question two, we have pretty much two lots of recommendations in a sense. One is coming from the smart investment. The other is coming from Nathan and you. Not quite a recommendation, but in a sense, I would follow that as well. Sometimes I found it difficult to sort of, we got two lots. I know that we had different mandates, right? The intelligent investment, pretty much value orientation, right? The others perhaps not. So sometimes I find it hard to follow them. Why don't we combine these two together, or in some way cooperate them together, so that easy for people to read or follow or research or whatever? Thank you.
So I can answer probably all of those questions, but then I imagine Nathan and Alan will have some ideas as well. So we don't really mind, we put all these resources together to help everybody. And some people will decide that they want to do it themselves, and some people will decide that they would rather let us do it, which is the same sort of philosophy. So it sort of comes down to your own your own personality of whether you're retired and you like playing golf or gardening, or whether you actually, we've got both sides, do you know what I mean? So in our subscription products, we show you exactly how we invest and what we've invested in, both in all the ETF portfolios and the II active portfolios. And so you can then go and do that yourself, or we can do it for you via the funds. It's sort of like, it's not a question that I can answer for you. It's sort of like, depends on your personality and your time constraints. I mean, we put out a lot of information, and not everybody, we actually term the people who do it themselves as sort of like investment hobbyists. They love reading all that information and doing it themselves, and they get a kick out of that, and that's what they do. The reason why we capped those pizza basis ones, the boring passive ones, is because we see it more, yes, we do pick the ETFs, and not every ETF is the same as every other ETF. So we look at liquidity, we look at tracking error, we look at costs of those ETFs. So yes, you can go out, you could buy sort of like Essentials, which is one of our subscription packages. We've got 2, Essentials and Premium. Essentials includes all of those portfolios and Eureka Report. Premium includes Intelligent Investor and whatever you get in Essentials, basically, for $770. So you could buy the subscription, go and see exactly what we've invested in, the exact percentages, and then go and do that yourself. We believe for 451, though, because they're sort of like fairly passive and boring investments, and do the job, they beat all of the peers. The administration costs of doing it yourself, you get all the tax reporting. We think if you just had to ring up your accountant and give them all the information about the investments you've made, you're going to get charged more than $451. And so that's why we did that. So we don't really mind which way you do it. Go out and get a broker and buy them yourself, or do it through us. On the other question of sort of the recommendations, we have our analysts who do recommendations. They do buy, hold, and sells. They do spec buys and whatever else. But that's buy, hold, and sells, and we show you those model portfolios, and that's been audited back since 2001. The other stuff we do, and you'll always see, if it's a recommendation by our business, like a specific recommendation, we'll have a buy, hold, sell. We'll have a recommendation. We usually also have a price guide on that, and we also have a risk weighting. So for us, it always comes back to, it's not a tip sheet. It always comes back to how to build a portfolio. So we provide all of the metrics you need to manage a portfolio. So we provide whether it's a buy, hold, sell. We provide what sort of weighting you should have, and also risk measure. On the other stuff we do, which is, Alan can talk to, there are a lot of interesting companies out there that may not fit our perfect II value investing way. There are lots of, so for example, Alan interviewed Split It yesterday, which has gone up massively in price over the last few months. It's a sort of another Afterpay. That's an interesting company. If we gave that to the analyst will go, what's their competitive advantage, what's their value, they're overpriced, blah-de-blah. No offense to Intelligent Investor, but they wouldn't want to cover that. But then we have lots of our members who go, yeah, okay, that's fine, I understand that, but I just want interesting ideas and I like researching, so I'll go and do that myself. And that's why we cover a lot of other companies, whether that's through CEO interviews, through our tools. So through the research tools, you can go and have a look at moving averages. You can have a look at, announcements, insider trading. I mean, it's one of my favorites. If you go to the share tools, you can go to director interest, like who's buying and selling their own shares, and you can search for all those companies. And it's just another way of finding interesting companies, but it's not a recommendation. I don't know. That's my explanation, but.
Yep. Do we have a full money-back guarantee on our Essentials pack still?
Yep.
So to me, what I always say to people is go and try the Essentials Pack and try and do it yourself for 6 to 9 months. And I absolutely guarantee by the end of that period, you'll know whether you want to do it yourself or you want someone else to do it for you. And you can't lose money because, well, you can if you pick the wrong stocks, but it's a full money back guarantee. So if you don't think you've got what you paid for, then you have your money back, and then you can go and invest in a fund or whatever you want to do.
G'day, gentlemen. Look, I think we live in the most exciting of times. I mean, everything is just transforming, and we're going to see, I mean, my belief is we're going to see some big names hurt, and we're seeing a lot of young names coming up, as we've seen in the FANG stocks in the US, and we've got our own wax stocks out here. But I'd like to get a sense across you, like in terms of the next 10, 20 years, just how fundamental do you think that shift is going to be? And, you know, sort of how much weight, personally, you're putting behind that?
Start this side. So I think there's definitely change. I think what's becoming more difficult for investors is that the old winners were, in a sense, easier to pick. And because I talk about Coca-Cola and how durable its competitive advantages were, you're just sitting back even as far as probably 5 or 6 years ago going, no one can kill this business, it's just going to keep on going. And I went to an exhibition on the weekend, the Body Vitals, and it showed pictures of different families around the world, and the Mexicans who could barely afford any food bought 14 2-litre bottles of Coke every month. Now you thought that's going to spread all across these emerging markets, and actually it's not happening like it did. So I think what's more difficult when you start looking at companies that, for example, operate in the cloud compared to companies that used to sell hardware, the moats aren't as durable, and the length of time you've got before the competition catches up is much less. And I think the change is there, and trying to pick the winners looks awfully easy when you look at Google and Facebook, but the easy wins have been had now, and I think it gets much harder for investors from here.
I think there are some huge changes taking place, you know, that cover everything. Possibly the most important one is the shift in the balance of power from producers to consumers, which has taken place, and that we're seeing that in persistently low inflation, because companies and workers, labour, neither companies nor workers can get their prices up. They've been trying and trying and trying, and the central banks see it as a central banking monetary policy issue, so they cut interest rates. Interest rates, you know, in Europe have been negative. Here they've been at 1.5% for, you know, since August 2016, trying to get inflation up. That's not going to work. It isn't working because the companies and the labour have lost pricing power. So that's a really fundamental, big issue. It's not changing in a hurry. And so the underlying everything is that. And then there's all these changes to business that are going on. So we've got artificial intelligence coming in, which is going to sort of permeate all businesses. You know, we've got cloud computing. We've got renewable energy, which is clearly going to replace fossil fuel energy. So that's, you know, that's a big change in specific terms. But and this is really important, and that's why I think that the sort of intelligent investor approach is really important as well, because even though all these things are changing, the fundamental way to make money, the fundamentals of investing and running businesses don't change. You know, the importance of cash flow, the importance of you know, of governance, of running a business properly, of watching costs and so on, they're all the same. So in many ways, things are changing, but they're also staying the same. So the fundamentals of business are not changing, and a lot of times it's easy for investors, I think, and for other people to think that because the world is changing so much, because there's so much disruption and so on, that actually it's different this time. But fundamentally it's not, and you have to think about businesses the same. And I see it all the time when I interview and talk to companies that are starting out, they're startups, and they're going to change the world. Actually, you know, 2 years down the track, they're grinding away, trying to get cash flow. They're grinding away marketing. They use the old kind of business things that you have to do in business. You know, your flashy startups are doing that, and that's how they're going to succeed. That's how they succeed in the end, not by their flashy kind of approach.
Yeah, I think apart from that, I think that shareholder activism, I think, the ESG concerns, I think we've had a number of comments over the seminars of, people going, I don't get to have a change. I don't get to affect a change because I'm a small shareholder. I think that's slowly changing. And so how that's changing is because of the industry super funds. So I read a report the other week that pretty much these massive funds actually own pretty much 50% of all stakeholders in pretty much all companies now. And they have a massive voice. So, Australian super and these large industry super funds or even large retail funds now have a massive say in spilling boards or doing whatever else. And I think that's a massive change. And that's why these ESG concerns, I think, will happen sooner rather than later. If you've got everybody on Facebook for Australian Super, 2 million sort of members on their Facebook pages saying that they don't like fossil fuels or whatever else, then you see similar things with the Norwegian sovereign fund. You get Australian Super going, all right, well, we're not investing in this. So I think those ESG concerns will be whether it's ethical, but definitely on the governance side, the G side on the ESG, I think will become major.
There's an interesting chart I saw yesterday, and basically what it said was the length of bull markets have been getting longer and longer. Now, I don't know whether we're at the period where we've basically exhausted monetary policy and now we go back to something more like it used to be with shorter cycles, but all I'm thinking in my head is that when you get that chance, whether it's by stock or when there is a general market weakness or downturn, you just got to be in there making the most of those opportunities, because you've got governments and central banks all trying to manage this credit bubble, and the air's slowly coming out now, and you just don't know. It's hard to read the cycle now because the government and central bank just throw all this money at it, and it's just, I think that's what's upset a whole bunch of value investors. They're so used to picking the cycle well and buying in the downturns, but when it's 10 years and you're still waiting for the downturn, that's why you see their returns are really tailing off, and you're seeing these massive tailwinds for ETFs and passive funds, particularly in the US, because that's just extraordinary returns since the GFC. It's been the place to be, and no one's going to move until the returns tell you otherwise.
Something that you raised earlier on about one of the indicators of potential upside was a change of directorship, change of the boards. Two that sprung to mind there is AMP. Is its reputational damage so profound that even with the great board it's now appointed, it's still in the void? And in America, with the recent change in the GE CEO over there, a great company from $30 down to $6, back up to 7 or 8 or 9. Are they both examples that would come across your radar? And the other one is the ownership interest of the founder. And a great success in Australia in recent times has been Altium, which appears to also have that characteristic. Are they three companies that on those parameters would have come across your radar?
Yeah, so definitely. I actually bought into AMP when I was about the first thing I did when I rejoined InvestSMART last August. The share price had halved, and I thought with the new CEO, he would absolutely... I mean, remember AMP's had about 7 or 8 CEOs in the last 20 years, and no one's been able to fix the culture. But they've got no choice now. They absolutely have to fix the culture. They're essentially mandated to by the regulatory changes or the inquiry. So I actually thought this guy seemed like the right guy. The only problem I've got is all his options are priced in the $5 range, and AMP sold off that life insurance business for a pittance after he had struck his employment contract. So I was actually wondering whether AMP were going to come back and lower the hurdles on his options, because I'm looking at it going, where is this guy going to find, basically how is this guy going to double the market value of an old company like AMP in an extremely competitive environment at the top of a market cycle and earn his options? And that's the question I can't answer at the moment. But I sold out at about the same price we bought it, because once they sold that life insurance business, it seemed the obvious upside was gone. GE, perfect example. The old Danaher CEO, for people who don't know the Danaher name, it's a very famous US stock, just run by a family who've just made an absolute fortune, just really good operators. The guy there has come into GE and he started fixing the balance sheet. And if you read through some of the international funds that are listed here, like the Antipodes and Platinum and whatever, they're all invested in GE and they talk about it, but it seems like it's going to be a reasonably hard road to fix the balance sheet first. And Altium, I wrote this, I had a quick look at it in about 2013. I wrote this wonderful 200 words on the Intelligent Investor website, and so I need to come back and have a proper look at this. Share price, I think, was $2.20. And then I left not long after that and never got back to it. So it's only price holding me back on Altium, and every time I blame the price, it goes up another 40%. So I've just been wrong, and might be wrong still. I think the outcome from the people I know invested in it for a lot closer than I do, they all talk about, is it the big French, it starts with a D, I can't think of the name, but the big shareholder will probably end up buying it at some point, but I don't know why they haven't bought it already. Maybe the CEO doesn't want to sell yet, and I can't remember how many shares he owns, but that's a perfect example. And interestingly, it took him 2 or 3 goes in the business world to create Altium and be in the right place at the right time. So you've got to watch these guys, and there's some funny stuff that went on with his previous business, and then he was moving to Asia, and I thought, what's all this about? And what is it, like up 15 times since then? So yeah, absolutely. There's just something about these guys. They're entrepreneurial is a thing, and I don't think that's what a lot of the corporate CEO, the career CEO, someone that comes in for 5 years, he's got the board approval to do what he's going to do, and he needs to get the performance straight away to get his bonuses up because he's not going to be there very long. And he's going to probably want to move on to the next thing. So that's why you see that really bad behaviour. They're only thinking about the next 3 to 5 years. They leverage up, they make a stupid acquisition, and I didn't go through the story, but I always pick on Mike Smith, who was the only guy that got rich out of ANZ's expansion to Asia. The bloke who lives in the $14 million house down on the Victorian coast. And the worst thing is Shane Elliott comes in and the board says, you need to fix this. And they strike all his options down here where the share price is, just so he can get the share price back to where it should have been before Mike Smith come along. So as an investor, you pay twice. All right, so yeah, that's exactly the sort of behaviour I want to avoid.
Alan mentioned about living up to 105, and I certainly hope to live up to 105 and probably beyond. Given that context, I just wanted to get the panel's opinion on the whole investment model. We live in a world of finite resources, and whereas the investment model assumes that there is going to be infinite growth, that there's a world of infinite resources, and that population will grow infinitely. So, which we all know, I mean, in the context of climate change, is probably not sustainable. So given that context, what future do we have as far as investment is concerned?
Alan?
Well, okay. I've got 40 years to go, right? So I think that longevity risk is an issue for all of us as investors. It isn't the case anymore that we retire at 65 and die at 70, so we don't have to worry too much about investing. Actually, we probably can't just kind of forget about it. We have to focus on growth to some extent, even in retirement, I think. And so, I personally, I'm not a pessimist about the world in general. I think, I've got to do a speech in Sydney in a couple of weeks' time at a climate change conference, and I've been thinking about what I'm going to say. And apart from bagging the hell out of the coalition for mucking up the policy, I actually think there is a problem because climate change is starting to happen, right? So I think that one of the things the government is going to have to do is deal with mitigating the effects of climate change. And I do think there's an issue there, but it's not turning me into a kind of an Armageddonist at this point. I don't think we need to, go and live on a mountain somewhere at this point. However, I think we need to think about the fact that there is going to be some effect over the next 10 or 20 years, during which time we'll probably be alive. So, I'm just kind of trying to balance my sort of inherent optimism with a bit of realism, I guess, about the fact what's going on with the climate. But on the other hand, this gentleman over here was so right. I mean, there's so much going on. There's so much excitement. It's such an interesting time to be alive now, to see how the world's changing. I mean, I just want to stick around for as long as possible to see what happens. It's great.
But Alan, the question is, The question is, the investment market, and as investors, we always constantly look for where is the growth going to come from? Where is the share price going to grow? So therefore, where the business is going to grow. And in a finite world, there's only so much a company and a business and the market as such can grow before after which it just reaches a saturation point. So therefore, what future do we have as investors?
Yeah. Well, look, I do think it's easier to find, you know, in a sort of big picture sense, it's easier to find industries that are in trouble. So, I mean, I knew 20 years ago, or 15 years ago at least, that the media industry was in trouble. And you should get out of Fairfax and you should get out of other traditional media businesses. That was kind of obvious. And you should invest in online classified businesses. That was true 10 or 15 years ago. It was just blindingly obvious. And I think there are some things like that that are blindingly obvious now. Shopping centre retailers are in trouble. Owners of shopping centres and the retailers have a long-term fundamental problem because online shopping is only going to go up. It's not going to be 100%, of course, but it's going to be more than 10%. And so that is just kind of obvious in a way. There are a number of other things that are obvious, I guess. Fossil fuel is challenged. It's going to go down. And renewable energy is going to go up, of course. Cars are going to go electric at some point. That's obvious. So there's a number of sort of really obvious things that we can see. And I do think it's not stupid to follow your instincts. I mean, it doesn't mean that every fossil fuel company is going to suddenly crash and burn, or every retailer is going to crash and burn. I mean, there's a few retailers that have been going great in the last year or so. What's that one that owns Athlete's Foot? No, but most of them are turnarounds, to be honest. The retailers have been going okay. And some shopping centres will last longer than others. I mean, I go to Chadstone sometimes in Melbourne. It's incredible. You can't move. But then I go down Bridge Road on the way to work, and every second shop is empty. So, look, I mean, just because there's a big theme taking place doesn't mean that every company, every stock and investment within that theme is going to go the way of the theme. But it is, I think the generalisations are valid.
I think on the investment side, as long as humans operate in stock markets, there will always be opportunities to make money. So I think you need to worry less about where the growth is going to come from and just make sure you're taking advantage of the opportunities that come every day in bull markets, in bear markets. And that's what we live for, is just looking for the mistakes the market's making. But a strategy that I keep thinking about, and I'm sure everyone here is going to say that's not suitable for me, but I keep thinking about how I'm going to be investing when I'm in your situation in not too long in the future. And I know most people here are all about income stocks, but it turns out the average person is dying with 1/3 of their retirement funds still intact. And they say the reason for that is because people are very frightened about low interest rates and medical bills and all these sorts of things that are coming up. And so they're actually not spending all the income they're getting anyway. And there's actually, incredibly, a whole bunch of people that weren't even spending the pension amount on a weekly or fortnightly basis. So things I'm thinking about are, why am I in such old, stale businesses like, say, Woolworths and Coles and banks, when I'm potentially going to be living for the next 20 or 30 years, and I could just be invested in a small cap index fund, and I should be getting 10 to 12%, not every year, but over the next 10 or 20 years, and you can have that growth because you don't need all the income that a lot of people don't seem to need and are actually just carrying it for fearful reasons that are in some cases unwarranted. So I think the idea of just getting dividends, spending them, get the dividends, spending them, in its own way might be becoming a little bit outdated, and need to think about more getting into growthier things, not getting into too much more risk, like an index fund is still fairly low risk, to get a higher return over time, but instead of waiting for the dividend all the time, over time just selling some of the capital, which is what Warren Buffett always says to people with a lot of Berkshire Hathaway shares. He says, don't worry, we don't pay a dividend, just sell some of your shares when they go up. Now, not every CEO has that much confidence in their business, but you get the point.
Yeah, I just have a question. As a retiree, how much money should you have in cash as a reserve? And secondly, of percentage of your portfolio. And secondly, why is it that term deposits offer such a low rate for self-funded funds, compared to individuals? And my second question is, for an active investment, does it have to be a managed funds or can it be exchange-traded fund as well? And does it have to be local or international?
Alan.
Alan.
So the first question is how much cash as a retiree, is that right? Everyone's different, really. I mean, that's what we talk about with risk profiles, I guess. I'm not much of a cash guy myself, but I'm not retired, I mean, so the answer is probably somewhere between 10% and 30%. I think you need some cash to take advantage of opportunities that come up. I think you need to have a bit there in reserve. It isn't so much, I don't see it so much as a necessary an asset allocation thing or a risk profile thing, but something where you need to have some at least. And the rebalancing that Ron talks about is what's important, really, is that whereas you have in your mind the sort of portfolio construction that you're comfortable with, and you rebalance so that if shares go up a lot, you move some into cash in order to rebalance and keep your percentages roughly the same. And I think that is a good principle, and that's that's one of the things that InvestSMART relies on. Term deposits, well, yeah, I mean, interest rates are low at the moment, and you're not getting much from the banks. That's the case, but at least it's safe. That's the whole point about cash, is that it's safe, and you shouldn't see cash as an investment where you're looking for return. You should see it as an alternative to investing in a way. And so locking it up, yeah, you might get an extra 0.5% because you've locked it up for 12 months instead of having it at call. And I don't have a problem with that. I mean, but you're not going to, I mean, if interest rates have gone up such that you're getting a decent return from term deposits, well, then inflation's out of control and we've all got problems. What was the second question? I'm sorry?
International or domestic?
Oh, international or domestic.
Yeah, look, the question was for an active investment, does it have to be a managed fund or can it be an exchange-traded fund, and does it have to be domestic or international?
Look, I think the best way to invest internationally as an Australian is to invest in funds that are either ETFs or international funds. There are, I mean, I actually think that a lot of, I'm going to argue against myself here, a lot of the Australian companies that are listed on the ASX that are based here are actually global international companies. So CSL, is one of our greatest companies in Australia, but it's an international company. But it's in a domestic portfolio, which I think is ridiculous in a way. I mean, I think you should be thinking about it in terms of where the revenue comes from, and constructing your portfolio that way. So how much of the revenue coming into your portfolio is Australian and how much of it is international? I think the construct about where the company's based is artificial. So as to what percentages need to be international or domestic, to be honest, I think the Australian economy is in more trouble than the global economy at the moment. So I would tend to have more in international exposure than I would in exposure to the Australian economy. But as I say, investing in CSL is a way to get international exposure, or Boral, or CSR, or lots of companies. There are so many companies, large companies, good, solid, well-run Australian companies that are effectively global.
So you don't have to go to the expense of an expensive managed fund. You can do an exchange-traded fund, for instance, internationally.
Yes, of course. Yeah, well, my son just yesterday put a couple of $1,000 in a new ETF that BetaShares runs called, I can't remember what it's called, but it's the 150 highest quality global stocks. It's sort of this, they've got a quality filter on global stocks, and it's an ETF that only invests in the top quality global companies. I think it sounds great. It'll be a low fee fund for sure. And InvestSMART has an international ETF.
Our international portfolio has got about 8 to 10 international ETFs that we manage, and that's capped at 451. So I don't know if we've invested in this new beta shares one, but just remember with ETFs, not every ETF's the same. So some ETFs that say they track the MSCI or track Japan or track Europe, sometimes they don't track it as well as they think. So you don't get the returns you think you're going to get.
Yeah, and also they're more expensive than they seem, and you need to really focus on fees with ETFs. Some of them are quite cheap, but some of them actually the fees are creeping up to 0.5%, and once you get into 0.5%, you're starting to get into quite a decent compounding effect on the fees, so that the $451 that InvestSMART charges is good, because you get a range of ETFs within the fund.
Yeah, the other thing, to answer your question, I mean, if you use the portfolio manager on InvestSMART, which is free, it allows you to construct a portfolio against your own chosen risk profile or ones that we've sort of chosen for you. And we sort of say, you know, this is a conservative portfolio, this is a balanced growth, a high growth, this is how much it would have made in the last 5 years, 10 years, 20 years, this is how much it loses, how much it's lost in, you know, the worst year in 10 years or best year in 10 years. And so you can see all of that maths, those metrics, and then you can choose whether that's the sort of risk profile for you, and then it'll tell you what sort of allocation. So in most of our portfolios, we have not overweight, we have more weighting to international than we do to Australia. And the reason being is Australia only makes up 2% of the world. So the Australian stock market is pretty much controlled by 20-odd stocks. Majority of them are banks and resources. You don't get much technology exposure in the Australian market, though it's becoming more so. So, you know, we have more weighting in pretty much every one of our risk profiles. We have more weighting to international than we do to Australia.
Sorry, I missed what you said. What was it called? Cap, what was it? The ETF one?
No, it's just called the international portfolio.
No, you had something there you
Capped
mentioned.
fees.
Oh, it's capped fees. It's that 451. You know where I said
okay.
What Ellen was talking about. We cap
Sure.
our fees on all those ETF portfolios.
Okay, fantastic. Thank you.
No problem.
Gentlemen, I was wondering what InvestSMART and Intelligent Investors' approach is to the asset class of private equity, and in particular, a recent presentation I saw at Pengana Private Equity Trust, where there's access for retail investors to get onto private equity. It represents 98% of equity in the US, for example. Listed companies only 2%. I was wondering whether or not that's something that would be on the radar, or is it the fees of that sort of fund going to be too expensive for you to offer? Or just wondering, what's the attitude towards expanding the assets under consideration to include the asset class of private equity?
Yeah, so we don't. I mean, private equity isn't really a traditional asset class, as you probably know. Private equity for us does have really high fees. It's quite hard to get exposure to private equity with low fees. The other problem with private equity, and we've been talking about this a lot, is, you know, think of blue sky. You know, it's very hard to price. You know, so when you invest in a private equity firm, the private equity firm is investing in different companies, and a lot of those companies, the company themselves can actually dictate what the price is, and so it goes up. That's how Blue Sky got into so much trouble. Remember Blue Sky? It sort of like priced all of its stuff. You know, we think industry super funds may have a problem with that in the future. We were only talking about this yesterday, where they've got all these infrastructure things and private equity and whatever else. There's no market to say the exact price. You know, at least with our stuff that we have in our funds or Nathan has in his funds, there's a public market, there's a public exchange that says that's its price. It's very hard to price the constituents of a private equity fund. And so you're relying on that fund, maybe the auditor or whoever they're getting in, to actually say what the price is. It's hard. I mean, the fees are the ones that blow us away. It's hard to get exposure to it at a cheap rate. I don't know what Ellen and Nathan think about it.
Oh, well, I think some of the industry funds are getting decent returns from illiquid investments like infrastructure and private equity because illiquid investors do tend to outperform over the long term. You know, in a sense, you pay for liquidity, but liquidity is valuable, so you should pay for it in a way. The lack of liquidity in private equity infrastructure is a problem. Well, that was what Blue Sky did. That was their whole thought, was that they would provide private equity type investing for retail investors. And as Ron said, they got in a strife because of the pricing of it. Now, maybe this new one has got it right, and good luck to them if they do. You'll definitely find the fees are high, and maybe they'll kind of their returns after fees will be worthwhile. Maybe they'll be in the 22% of funds that outperform. Who knows?
There's some easier options in the US if you're looking for private equity type investments. There's actually a whole bunch of listed companies that do some of that stuff. And they have locked up capital like an oak tree or something like that.
Thank you for the information. I wish I'd come to this seminar 5 years ago. And in terms of fees, I trusted my financial advisor. And based on all the bamboozling and the terms that my funds were doing really well, now that I'm not working, I just found that I paid over $100,000 in fees over a period of 5 years. So now I'm going to do my own due diligence, but I'm also bamboozled with the complexity of the whole investment area. So I've attended quite a few seminars. I've got recommendation on a portfolio. I just like the question is, how do I go about, designing a portfolio that's best for me? And I don't have a lot of knowledge, and I have to rely on my financial advisor. So therefore, how do I go out and find a financial advisor that I can trust and partner with? That's the first question. The second question is, can my financial advisor also invest in your portfolio, and do they do cross-investing across different financial advisors?
So I'll answer some of those questions. The first question I would ask a financial advisor is, how do you charge me? And I think a financial advisor, like I go to the doctor doesn't get a percentage of the prescriptions he's actually prescribing me. So there are true fee-for-service advisors, and that's the guys I would be going after for, like I go to an accountant, a lawyer, or anybody else. Can your advisor invest on your behalf in our funds? Of course. But is he going to then put 1% on top of that? Because that sort of like destroys my whole idea of a fixed, 451 cap. Because now he's still getting 1% of your funds, even though I'm only charging you $451. Where to start? We do a lot of webinars. We do a lot of online webinars. We do a lot of online videos. They're all free. The portfolio manager, we've spent a lot of time on creating that portfolio manager and doing that health check. And like I was saying to the lady before, go in and just start playing with it and seeing what sort of risk your financial advisor would, if you're in retirement, the financial advisor's probably moved you from growth to balance. He sold a couple of funds, charged you a fortune. Sorry if there's any financial advisors. Some financial advisors are really, really good. Some financial advisors, we have people all the time ringing up and saying they're getting charged $30,000 a year. We had a guy the other day. I mean, Alan can tell you about one of his friends, $30,000 a year. There are a lot of fees being taken out of these portfolios. And the best way to arm yourselves against that is to educate yourself. And so, I applaud you for going down that journey. I think there's lots of resources available. The money website the government puts out. InvestSMART, there's lots of material on that. Go and play around with the portfolio manager and sort of play around with what sort of risk profiles you think that you are. You might have more than one portfolio, so you can have a different risk profile for different portfolios. And it's just educating yourself. So when you do go see your advisor, whichever advisor you choose, at least you're armed with the right questions to ask them.
I've just finished a book last weekend on this subject, which will come out in a couple of months' time, which is about how to find a decent advisor, what questions to ask, and also just some basics about educating you on investing. It's also, I'm quite critical of the Royal Commission, because I think that he should have recommended restructuring the industry so that there's a separation between advisors and product manufacturers, wealth managers. There should not be, in my view, it shouldn't be allowed for investment companies to employ advisors as quasi-salesmen, when in fact, people go to them for advice, independent advice, not sales. And so I think that's a big issue. Ron referred to a friend of mine. He's got $3 million with an advisor, and the advisor was charging 1.3%. And I pointed out to him, well, that's $39,000. Do you think it's worth it, what you're getting? He says, well, no, because I'm only seeing him once a year, and he's basically passively investing it. So he's, you know, it's a colossal amount of money. So he went to the advisor and said, listen, you're charging me too much. I will now, from now on, I'm giving you $10,000 a year. And the advisor said, righto, that's fine. It was like $29,000 a year came off the advisor's fee, just like that.
You should have gone lower.
And even $10,000 a year, crikey, that's nearly $1,000 a month. You know, how many people are you paying $1,000 a month to? And what are you getting from them? I mean, so I think the way to find an advisor is to interview them. Like you're renovating your house, a few years ago I renovated the house, 4 builders, interviewed each of them, went with the final one. He was absolutely shocking.
You should write a book on that too, mate.
I mean, what do you do?
There's another book.
The other thing I'd say is investing is not rocket science. The thing about investing, what's hard about it, if you're really trying to beat the market, it's just a lot of reading and a lot of hard work, and most people just don't have the hours to sit there for 60 hours a week and keep unearthing these situations like 360 Capital, which even I went past it myself. I had to get a mate who had to explain it to me, and it was still hard to understand. And now I tell you, it's just a property business with a funds management business. But the amount of work I had to do to get it to understand that, and I missed it by looking at it myself, just shows you why the average person is never going to find those ideas. And when I first started at Intelligent Investor in 2006, my boss told me at the time that investment's actually 80% psychology or controlling your emotions and 20% analysis. I guarantee you, if you spend 6 to 9 months learning about investing, you'll know what a good business looks like. That's not the hard bit. The hard bit is controlling your emotions, being long-term, doing the work so you don't sell out when the share price falls, all that sort of stuff. That's what you pay us for. So don't underestimate your own ability to learn a lot in 6 to 9 months. And I always tell people, because they always come to us for a very similar reason, right? They've been ripped off, they're going to do it themselves, but they just don't know where to start. And so I said the same advice as what I said before. Get a subscription, it's money back guarantee, look at it for 6 to 9 months, and I guarantee in 6 to 9 months, your understanding of investing will go from down here to up here. You'll know what questions to ask your financial advisor. You'll know why you might want to use and start avoiding a financial advisor and just do certain simple things yourself. Because the fact is, for most people with retirement situation, is vanilla. They're all the same, and it shouldn't be a costly exercise. It's very easy. But the problem is a lot of financial planners just might make it seem complex so they can charge you higher fees and make it look like they're earning their money when they're not.
Thanks very much, because this seminar is really good. Give me the simple message to take home. First, low fees. I should just look at the low fees. That's good. Second, don't time in the market. Okay, don't look at the chart. Just go in. And the third one, invest ethically. Ethically, because the air condition killed me, not because I'm Chinese. Anyway, first of all, I said I'm a long-term Alan Kohler fan, and there's no free lunch. Subscribe to Alan Kohler's The Constant Investor was really good. And I really enjoy every weekend reading, because if I don't read, I feel I'm blind to the world. And I really enjoy that gentleman said about this is an exciting time to live with, because everything's just moving so fast. I don't know whether this is another industrial revolution come time, because all the things happening. I think it's exciting. Now, I will be quick, because just before I get killed, I'm by the air condition, not by investment idea. I keep saying to my husband, yes, investment is not rocket science. I can do it. But the first question I said, when Ron said, you know, his sister got wrong about that Platinum International chart. Okay, I read the charts. I think it's a long term, it's going there, that's good, I just go in. Now you said, because the fund's going bigger, so the charts incorporate these things. So got me very confused about this. I thought that the chart is just about the price plus end of year return. It's incorporated in there, not the fund size in there. So I got this question. Second question, I hold a large amount of money, cash, and I'm trying to go in. I'm just so scared to go in. All right, not rocket science. Because everything's going so high there, should I just blindly go in anything? No, I still can't do it. I have a large amount cash fund, cash. And also ETF, the third question, ETF is recently after GFC, isn't it? So has been tested, really? Because everyone go in. If want to get out really quick, or go in really quick, is that door seems very narrow? So 3 questions.
I'll have a crack. First one, I was talking about my sister-in-law, and she was looking at her own investment in a fund, and so it wasn't the price chart of the fund, it was her investment in the fund, and they showed how her investment portfolio had grown over time. And when we looked into it, it wasn't actually the fund performing, it was actually her putting money into the fund every month due to her superannuation 9.5%. The second one, cash. We always talk about dollar cost averaging. We talk about, in my market timing, talk about, you know, the dread effect, or you're talking about loss aversion. You know, you'd much rather not lose money than gain an equivalent amount. That's called loss aversion. So one way around that is to invest small amounts regularly, because depending on so we're not saying take all of your cash and put it on red or put it on black. You know, it's not a casino. It's, you know, it's actually investing in a diversified portfolio that matches your risk appetite, whatever that may be, and doing that slowly but surely over a consistent time.
I'm not that young.
I mean, we can't give you personal specific advice because it's general advice, but, you know, dollar cost averaging works, rebalancing works, you know, all that stuff is sort of proven. I don't know how to get you over your fear of loss, but, you know, hopefully one day you get over that. Thirdly, the ETF one. ETFs have been around forever in the US and Canada. They started in the 1970s. The only reason they haven't been in Australia for so long, and really interesting as a business, 20 years ago, we saw ETFs, or back in sort of like early 2000, we saw ETFs going off over in Canada. First one was launched in Canada, then in America. The only one that really started here about 10 or so years ago was a gold ETF. We went out and bought every domain name known to man in Australia. So we own ETF Advisor, ETF News, ETF Research. They were all available because no one's ever heard of an ETF. The reason why no one's heard of an ETF here is because you imagine going to an advisor. So this is how you distribute a product in Australia 10, 20 years ago. I'm Colonial First Aid. I knock on your door. I go, hey, Mr. Advisor, I've got a great product for you. He goes, yeah, come in. Tell me a bit about your product. About one sentence. Then he goes, right, how do I get paid? Right, you get 60 basis points for every dollar you put in. Yeah, so 0.6%. That's the sort of trailing commissions that an advisor would get paid. ETF guy comes along, knocks on the door, says, hey, I've got this great ETF for you. The advisor says, how do I get paid? Oh, well, your client can just buy it for $20 on the stock market. There is no trailing commission. No, we don't like that product. Go away. So when did ETFs take off in Australia? Straight away after FOFA came in, where the government basically said no to any products paying trailing commissions anymore after 2013, 1st of June. That's when ETFs took off in Australia. So have ETFs been tested all around the world? Yes, in all different markets. Are ETFs the best thing and most amazing thing? If you're a passive investor, you know, the downside to ETFs is you buy the good, the bad and the ugly in a market because you're buying the whole market. But for most investors, that's a much better and more disciplined way to invest than being able to pick stocks or whatever else. But our philosophy is really the pizza base. So you go, right, I'll put a large chunk of my money into a a pizza base, a diversified fund, and then I'll choose some toppings, and I might choose, you know, some direct equities or an ethical or whatever else. ETFs are an exchange-traded fund, so, you know, there's no difference between a managed fund and an ETF in some respects. If you're thinking about a run on a stock or a run on a market and you're trying to get your money out quickly, if you've got your money in a managed fund, well, that fund manager still has to sell those individual stocks within that fund to give you back your money. That same thing happens with an ETF, but it's sort of like behind the scenes. So I think it's a bit of a fallacy that ETFs have only been around for sort of like 10 years. They've been around since the 70s over in the US and Canada.
The ETFs that have scared people are the ones that have occasionally hit the headlines when there's been a fall in the market, have been generally the ones with a lot of leverage in them. Australia doesn't tend to have many of those, if any. In the UK and the US, there's a lot more of them, and there's also other ones that have got synthetic exposure, so they actually don't, it's not plain vanilla, they don't just own shares in good stocks, they own all sorts of obscure assets. So you've got weird investment holdings where the market's not as liquid, potential leverage on top of that, and they're the ones that we've seen in occasional downturns of the price has gapped really fast. But credit to the regulators on this one and rare, possibly only occasion, in Australia, they haven't let those through.
Thank you, everybody.